Okay, let's try to make sense of this. It's Monday, February 2nd, 2026. You glance at the market, and SoFi Technologies just took a 15% nosedive.
Yeah, it looks pretty ugly on the surface.
But then you look at this investment report we've got, and it's practically screaming strong buy.
It feels like two completely different stories, doesn't it? And that's exactly why we're doing this deep dive. The market is reacting to short-term noise.
The capital raise from last year, right?
That's the one. But this report argues the actual business fundamentals are telling a totally different story. The mission here is to finally debunk the myth that SoFi is just a student loan company.
Well, the headline here is pretty bold. They're calling SoFi the AWS of Fintech. That's a huge claim.
It is a massive claim. AWS basically runs the internet. The report's thesis is that SoFi is building the infrastructure to run modern finance.
And they're pointing to this Triple Crown performance in Q4 to back that up.
Exactly. Let's break that down. First, record-adjusted net revenue. They finally smashed that billion-dollar barrier.
Right, $1.013 billion.
But, the number that actually matters here is the consistency. This was their 9th consecutive quarter of GAAP profitability, $174 million in net income.
So that's over 2 straight years of profit. But let me play devil's advocate for a second.
Go for it.
Aren't they just riding the wave of high interest rates? I mean, what happens if rates drop? Does all that profit just vanish?
You see, that's where the whole AWS argument really starts to make sense. The report highlights that 57% of their revenue now comes from non-lending businesses.
57%. So from financial services and their tech platform.
Precisely. They're not just a loan company anymore. So unlike, say, a firm or Upstart, who are still kind of chained to those credit cycles, SoFi has built something much more resilient.
The report calls it a triple pivot that got them here. Can you unpack that? What did they actually change?
It was a strategy they ran all through 2025. The biggest part was the funding pivot. They stopped borrowing expensive money from Wall Street to fund loans.
And started using their own member deposits instead.
Yes. They're sitting on $37.5 billion in low-cost deposits now.
Which must save them an absolute fortune on interest payments.
About $500 million a year, according to the report. That just drops straight to the bottom line. It's also how they got a Rule of 40 score of 68.
Okay, I know the Rule of 40 is a big deal for, software companies, but for a bank, is 68 actually good?
It's incredible. It's almost unheard of. It means they're growing at a rapid pace while also being highly profitable. And that proves their model works, what they call the financial services productivity loop.
The FSPL, that's their flywheel concept, right?
Basically, yeah. They use low-cost products like a checking account or free credit monitoring to get you into their ecosystem.
To get you in the door.
Right. And once you're a member, the cost to cross-sell you a high-margin product, like a personal loan or a mortgage, it's almost zero.
A zero acquisition cost on that second product.
Which creates huge margins. But this is where the AWS metaphor really clicks into place. We have to talk about the tech platform.
Galileo and Technisys. The plumbing.
The plumbing that other banks and fintechs are now running on. But the real catalyst, the thing to watch in 2026, is the SoFi USD stablecoin.
I have to admit, that part made me do a double take. A national bank issuing its own crypto on a public blockchain. That sounds incredibly risky.
It sounds risky, but think about the goal. AWS provides servers. SoFi wants to provide the rails for money. Moving institutional money across borders right now is slow, it's expensive, it relies on ancient systems like SWIFT.
And a stablecoin could bypass all of that.
Instantly. It's not about letting you buy crypto. It's about rewiring the banking system itself. They're even launching SoFi Pay in over 30 countries to go after Western Union.
Okay, that's a big vision. But let's bring it back to the price. The stock's at $22.81. This report says it should be at $35. If it's such a great story, why is it so cheap?
It all comes down to the metric you use. The market is looking at PE ratios, and you see a firm at 89 times earnings or Upstart at 182 times. They look expensive.
But SoFi is different.
The report argues you have to use the PEG ratio, the price earnings to growth ratio. You have to factor in how fast they're growing.
Right, so you're not just valuing today's profit, but tomorrow's growth.
And on that metric, SoFi's PEG is near 1.0. In investing, that's basically the definition of cheap. The market is pricing it like a boring old bank, but it's growing like a tech company.
All right, we have to be objective. What kills this whole story? What's the bear case?
In a word, regulation. Since they're a bank, they have to deal with things like Basel III capital requirements.
I think that makes sense for me.
It's basically rules that force them to keep more cash locked up in a vault as a safety buffer. And every dollar they have to lock up is a dollar they can't use to grow the business.
So it's a drag on growth.
It can be. And then, of course, there's the crypto piece. The government isn't exactly famous for loving banks that mint their own digital dollars.
Right. If the political winds shift, a crackdown could just evaporate that entire global payments narrative.
It's a minefield, no question.
So what we have is a company that's clearly graduated from a cash-burning startup to a profitable machine. But it's got this heavy regulatory risk hanging over it.
That's the tension right now. They've proved the business model works. The question is whether regulators will let them truly scale it globally.
Which leaves us with a final thought to chew on. With a stablecoin and these global payment rails, is SoFi just building a better bank? Or are they actually building the very future of banking infrastructure?
That is the multi-billion-dollar question, isn't it?
Keep a close eye on that tech platform growth this year. Thanks for listening to this deep dive.